Hi, we're going to get ready to take Exam 3, which is over chapters 5 and 6. To help you prepare for Exam 3, I'm going to work one of the exams that's out in Blackboard. So this one I'm going to work is Exam 3A. And Exam 3A and its key is already out there in Blackboard. I'm just going to talk about how to work it. And I'm going to do it in 3 parts. I'm going to work question 11, then upload that, work question 12, upload that, and question 13, upload that. You can expect pretty similar questions. Certainly there will be a section on sales and purchase transactions, and you'll have to journalize them. Definitely you will prepare a multi-step income statement, and definitely you will be doing periodic inventory, LIFO, FIFO, weighted average cost, merchandise inventory, and cost of merchandise sold. So may look slightly different, but may have more or less of one or the other, but these will be the 3 basic things you have to do, along with the typical multiple choice questions on concepts. So let's start out and work question number 11 from Exam 3A. Question 11 is just 5 transactions. They're mix of sales and purchase. So the first thing you want to make sure is you're understanding the distinction between purchases and sales, right? And how you do the accounting for these two, right? So think of it from the perspective of whoever you're doing the accounting for. So in this case, we're doing the accounting for the Driscoll Company. It's a jewelry store. And so they're doing some sales and they're doing some purchases. So if we're counting for Driscoll, so whenever Driscoll buys something that they're going to turn around and resell, that's a purchase. And whenever they make a purchase, whatever it is they purchase becomes merchandise inventory. All right? And they either pay cash for it or they have an account payable that they're going to owe for it. Whenever Driscoll Company makes a sale, right? They sell some of their jewelry to somebody outside. That's a sale. And when we have a sales transaction, we need to account for the revenue, which is going to be sales. Of course, we're going to get either cash or an account receivable in exchange for that sale. Then we also have to do that second transaction that reduces the merchandise inventory and increases our cost of merchandise sold. So let's just get right into it. This is question 11 from Exam 3A. So the first thing that's going on is March 1st, we've purchased watches on account from Sarita Company for $4,000, terms 210, net 30, no freight costs. All right, so let's make sure we understand what's going on. We're doing the perpetual inventory system, so that means, this is like from chapter 5, perpetual. As we do a sale, we reduce our inventory. That's what that means. This 210 net 30 means we get a discount of 2% if we pay within 10 days. But if we don't pay within 10 days, then we just owe everything after 30 days. No freight costs. All right, so this should be pretty simple. Let's go ahead and put that purchase on. So, like any journalization, we got the date, we got the account, we got debit, and we got credit, right? So once you get those on, we can just get started. Purchase watches, $4,000, 210 net 30. So that means we didn't pay cash for it. We've got an account. So that's an account payable. What did we get in? We got in watches. Right, so watches are our merchandise inventory, so this is on 3-1. Right, that's what we sell. We're a jewelry store. We sell watches, so that becomes our merch inventory. And we have an account payable to, who do we buy them from? Sarita Company. Right, it's important to make sure you're keeping track of who you owe. So it's not just an account payable, it's to a specific party. And 4,000. And 4,000. And we're done. That's easy. Purchases are kind of easy. Not that difficult. On March 3rd, We sold watches, so this is going to be a sale. Sold watches on account, so we're going to get an account receivable because they're not paying us for them yet. To Bishop for $5,000 for terms 110 net 30. So if Bishop pays us within 10 days, we're going to knock 1% off. The cost of the merchandise sold was $3,500. There are no freight costs. All right, so there we go. Easy peasy. Sold watches on account for $5,000. So let's take care of that revenue first, and that's March 3. Right. So we've got the account receivable from Bishop. Right, and we have sales, and the amount was $5,000. And now we got to reduce our inventory. It told us the cost of merchandise sold was $3,500. Right. And of course, that came out of our inventory. We've reduced our inventory. And it tells us $3,500. That transaction's done. Next, on March 9th, we paid Sarita for the March purchase less discount. All right. So what was our discount? Oh, okay, well, when we bought it from Sarita, we had $4,000 with a 2% discount. And we haven't returned anything. So it's that full $4,000 that we owe Sarita. So let's see. So 2% of $4,000 is going to be $80. And I'll just go ahead and calculate that for you. Right? Discount. 4,000 times 0.02 equals 80. Right? And of course 4,000, that's our account payable. So the cash we're going to get from them is 4,000 minus 80 equals 39.20. Right? So there we go. We have all the numbers we need. The discount, that we're going to pay them, the cash we're going to pay them, and our account receivable amount. Our account payable amount. All right. So this is 39. So we're reducing our payable to Sarita, which, as you know, has a $4,000 balance. And in addition to that, we're going to pay out cash and reduce our merchandise inventory. The cash is $39.20. This is 4,000. $39.20, and merchandise inventory. So this represents a reduction of $80 worth of merchandise inventory because, well, we didn't actually pay that for the merchandise inventory. We only paid $39.20. And you'll notice how these two credits add up to our debit amount. So we're very happy with that. Next, sold watches for cash to Petronilla Chapman, $2,000. So cash, no account receivable. Cost of merchandise sold was $5.95. No freight costs. Okay, that shouldn't be too difficult. 3, nothing to really calculate. We get cash. And of course we had a sale. That's how we got that cash. And we are going to have more cost of merchandise sold and a reduction in our merch inventory because somebody bought it. It went away. So the sale amount was $2,000. And the cost of merchandise sold, $5.95. Last, March 12th, Bishop Company paid off his account less the discount. Okay, so Bishop sold watches to $5,000 and a 1% discount. Okay, so we need to calculate that discount. Did they return anything? No, they didn't. So let's just go ahead and put that down. 312. Of course, to calculate that, we're going to say 5, the discount equals 5,000 times 0.01 equals 50. You don't have to do this on your exam. If you can, in your head, go, well, 1% of 5,000 is 50, by all means, just go ahead and do that. And of course, the cash amount is 5,000 minus 50 equals 4950. So now we have all the numbers we need. The receivable balance, the cash, and the discount and the cash. All right, so this is going to be slightly different than when we had a purchase discount. This is a sales discount that we want to track, right? So cash came in, right, $49.50 worth, right? And then we have a sales discount of 50, right? So we're tracking these because remember we need to put them on our income statement, right? So we track them separately. And then our merchandise inventory, our account receivable, right, is no longer around because they paid us. So that account receivable goes away, $5,000 balance. And that's it. We did 5 transactions. You'll have something similar on the exam. There might be a purchase return or a sale return. So make sure you do some practice problems with those. But pretty much this is what you'll be asked to do. Some form of purchase and sales transactions, 5 of them. Alright, so we'll stop there, upload it, and I'll move on to question 12 in the next video.